To trade on a 5-minute chart is to operate inside a constant stream of market noise. The price action at this level is erratic and highly susceptible to sudden, unpredictable spikes in volatility. If you attempt to execute trades strictly based on these lower timeframe signals without any wider context, your trading system will inevitably degrade through a series of false breakouts and whipsaws. To extract true, actionable signals from this micro-noise, the raw data must be filtered through a rigid, higher timeframe structure. Look at this split-screen comparison. On the left is an unstructured, erratic data feed. On the right is that exact same price action, but constrained by precise geometric zones and center lines. This framework mathematically bounds the chaos, predicting exactly where the line will pivot. High-probability systematic execution simply cannot survive in a vacuum. It strictly requires multi-timeframe institutional alignment to strip away the daily market noise. The DRW True C Liquidity Matrix is a quantitative solution explicitly built to solve this exact problem of lower timeframe noise. Its core operational premise is mechanical. Every execution trigger on the 5-minute chart is anchored directly to the macro volatility boundaries of a 1-hour chart. Rather than relying on rigid historical averages that lag behind the market, this framework uses dynamic algorithmic lookbacks to adapt to real-time volatility. By operating this way, the matrix creates a mathematically grounded environment. Lower timeframe setups are structurally prohibited from firing unless they are backed by higher timeframe institutional momentum. The foundational layer of this framework begins with the 1-hour higher timeframe volatility block. This animated chart isolates the exact geometry of that volatility block. We define its upper premium boundary with an aqua line and its lower discount boundary with a fuchsia line. The most critical macro component of the system splits this volatility block exactly in half. This yellow center line is the 1-hour mean threshold, the 50% equilibrium point of institutional volume. This threshold dictates a strict binary rule for execution. If price action resides above the yellow threshold, the system exclusively validates long setups. Conversely, any price action trapped below the threshold exclusively validates short setups. The 1-hour mean threshold acts as an absolute macro compass. It mechanically prevents you from executing counter-trend signals against the prevailing institutional flow. With the macro boundary set, we can move to the execution layer. The primary operational sequence is the higher timeframe mitigation sweep. Here is an animated diagram showing the first mandatory condition. Price must drop to test the 1-hour main threshold, but it must reject it, leaving a long vertical wick intersecting the yellow line, while the solid body of the candle closes securely above it. This specific rejection pattern signals the algorithm to immediately begin hunting for structural displacement on the micro 5-minute chart. When displacement occurs, you get this exact confirmation signature. A green triangle icon fires right at the rejection point, instantly plotting a new horizontal boundary outward to the right. This newly generated dashed orange line is the true C-base midline. The execution logic here is strict. You do not chase the breakout candle. Instead, you place a limit order directly on the dashed orange line, anticipating a micro pullback. Waiting for price to retest this local mean threshold ensures your entry occurs at mathematical equilibrium, drastically reducing initial drawdown and tightening your overall risk. When the market shifts into an aggressive, high-velocity regime, we rely on a secondary sequence, the nested C or propulsion reload. The core utility of this setup is to identify and capture momentum continuations without having to wait for deep discount pullbacks that rarely arrive during strong trends. The institutional mechanics at play are straightforward. The algorithm detects that market makers reacted to an initial order block and immediately established a secondary, higher acceleration block to reload their positions. This animated chart shows how the system differentiates this high-velocity reload from a standard base entry. Price action pushes upward, pulls back slightly, and triggers a blue NC batch. This immediately generates a new dotted orange line positioned above the original setup. To safely take this aggressive entry, a strict filter is required. You must have multi-timeframe grid confluence, meaning the 15-minute, 1-hour, 4-hour, and daily metrics in your heads-up display all light up simultaneously in synchronous green. The propulsion reload allows you to systematically pyramid your positions with mathematical proof that institutional momentum is accelerating rather than exhausting. Beneath these visual charting elements is the mathematical engine driving the matrix, the Kaufman Efficiency Ratio, or KER. Standard technical indicators suffer from a fatal flaw. They rely on static, rigid measurement windows, like a fixed 20-bar lookback, that severely lag during sudden market changes. This diagram illustrates the quantitative solution, dynamic lookbacks. By calculating real-time market noise, the algorithm adjusts its own parameters on the fly. During high-velocity trends, KER automatically shrinks the lookback window to instantly capture and react to sudden momentum shifts. Simultaneously, when the market enters choppy, consolidating regimes, KER expands the lookback window to filter out false breakouts and noise. This live efficiency ratio operates transparently. The calculation runs continuously and is outputted directly to your heads-up display panel. Adaptive volatility modeling ensures that the trading framework evolves synchronously with market conditions. It preserves your execution edge even when the macro environment radically changes. The final layer of execution lies in the live risk and target payload matrix. Manual calculation of position sizing often falls victim to human error. Discretionary sizing under pressure frequently leads to emotional overleveraging. This stylized HUD interface demonstrates the automated data cascade that occurs the millisecond an active signal triggers. The system reads your exact account size and risk percentage, instantly outputting precise contract sizing and projecting horizontal target lines outward onto the price chart. The system strictly pegs the exact point risk to your account size, automatically delivering your critical payload contract size. Standardizing trade geometry alongside automated contract payloads creates a truly mechanical edge. It entirely insulates you from the psychological pitfalls of risk management. To summarize the complete workflow, your first step is to verify institutional bias by checking the 1-hour mean threshold. Second, execute your initial base entries exclusively on the 5-minute dashed orange line and your continuations on the dotted orange line. There is an ultimate non-negotiable risk management protocol that must be followed. Any setup is instantly, structurally invalidated if a candle body manages to close through the active entry midline. The entire visual matrix on your chart remains accurate strictly because it is underpinned by the adaptive math of the Kaufman Efficiency Ratio. Sustainable, systematic trading is not about forecasting the future. It is the rigorous application of macro context, adaptive algorithms, and strict geometric execution to consistently exploit institutional behavior.